What's up everybody and welcome back. Not every stock can be a winner. Today, we're diving deep into the downs. I'm talking about the Nasdaq 100's biggest losers so far this year. Let's get right into it. Alright, kicking things off at number 10, we've got Intuit. This company has been a cornerstone in the financial software industry for decades, providing essential tools for both individuals and businesses. TurboTax, QuickBooks, they're the backbone of personal and small business finance for a lot of people. These platforms have revolutionized the way we handle taxes and accounting, making it simpler and more accessible for everyone. But even with that kind of market dominance, their stock is down 6.54% year-to-date. This decline has raised eyebrows among investors and market analysts alike. These are supposed to be the heavy hitters. So, what's the deal with Intuit? Why is a company with such a strong market presence facing these challenges? Well, a lot of analysts are pointing to a few key factors. It's not just about the company itself, but also the broader economic environment that's impacting its performance. First off, the economy. When times are uncertain, people tend to tighten their belts, and that means less spending on software, even essential stuff like tax prep and accounting. This cautious approach affects Intuit's revenue streams. On top of that, you've got rising interest rates and inflation making things tough for small businesses in particular, and that directly impacts Intuit's bottom line. Higher costs and tighter budgets mean less investment in new software solutions. Intuit's still a solid company with a strong track record, but this dip is definitely something investors are keeping a close eye on. The company will need to navigate these economic challenges carefully to maintain its leadership in the financial software market. Coming in at number 9, we've got Ross Stores down 8.27% so far this year. Ross is all about that discount life, right? They thrive on offering bargain prices on name brand clothing and home goods. But even with that value proposition, they're feeling the heat. The retail sector as a whole has been struggling, and discount retailers are getting hit especially hard. Their whole business model is built around low margins, and when costs for everything from manufacturing to shipping are going through the roof, it eats into those margins big time. Consumer spending habits are changing too. This all adds up to a challenging environment for Ross, and their stock performance reflects that. At number 8, we've got Datadog, clocking in with an 8.31% drop so far this year. Datadog, they're all about the cloud. They provide monitoring and observability tools for cloud applications, and that's a booming market, right? So why is their stock taking a hit? Well, even in a hot industry like cloud computing, competition is fierce. You've got giants like Amazon, Microsoft, and Google all vying for a piece of the pie, and that puts pressure on smaller players like Datadog. When businesses are worried about a potential recession, they tend to cut back on spending, and that includes software and IT services. It'll be interesting to see how they adapt and navigate these challenges in the coming months. Coming in at number 7, it's PayPal, down 8.65% this year. This drop has been a significant point of concern for investors and market analysts alike. PayPal, they're like the OG of online payments, right? They revolutionize the way we handle money online, making it easier and safer to send and receive payments across the globe. They've been around since the dawn of e-commerce, but even they're not immune to the pressures of the market. The digital payment landscape is evolving rapidly, and staying ahead is a constant challenge. One of the biggest challenges PayPal's facing is, you guessed it, competition. The market is saturated with numerous players, each vying for a piece of the pie. Apple Pay, Google Pay, Shop Pay, there are a ton of digital payment options out there these days, and that's eating into PayPal's market share. These tech giants have the resources and user base to pose a serious threat. You've got a whole wave of fintech startups coming in with innovative payment solutions, challenging the status quo. These startups are nimble, creative, and often offer unique features that attract users. Plus, let's not forget about good old-fashioned credit and debit cards. Despite the rise of digital wallets, many people still prefer the familiarity and reliability of traditional cards. They're still the go-to for a lot of people, especially for larger purchases. The trust and security associated with credit and debit cards are hard to beat. PayPal's got its work cut out for it. They need to constantly reassess their strategies and find new ways to stay relevant in this competitive market. They need to innovate, adapt, and give people a compelling reason to choose them over all the other options out there. Whether it's through new features, better security, or more user-friendly interfaces, PayPal must continue to evolve to maintain its position as a leader in the digital payment space. Sliding into the number 6 spot, we've got Biogen, down 10.19% year-to-date. Biogen's a big player in the world of biopharmaceuticals, specifically neurological treatments. They've got some major drugs on the market for conditions like multiple sclerosis and spinal muscular atrophy. Drug development is expensive and time-consuming, and there's always the risk that a promising treatment won't pan out or will face regulatory hurdles. On top of that, there's constant pressure to innovate and bring new drugs to market as patents expire and competition heats up. For Biogen specifically, there have been some concerns about their Alzheimer's drug, Aduhelm. This uncertainty has definitely weighed on their stock price. Coming in at number 5 is Honeywell International, down 10.24% this year. Honeywell, they're a massive conglomerate with their hands in a lot of different industries, from aerospace and building technologies to performance materials and safety products. They're like the Swiss Army knife of companies, but even they're not immune to economic headwinds. One of the biggest challenges for Honeywell is the slowdown in global growth. They're a truly global company, so when economies around the world are struggling, it impacts their bottom line. They've also been dealing with supply chain disruptions, which have been plaguing businesses across all industries. Despite these challenges, Honeywell is still a solid company with a diversified portfolio. At number 4, we've got Electronic Arts, better known as EA, down 11.55% year-to-date. EA is a gaming giant. They're the name behind some of the most popular video game franchises in the world, like FIFA, Madden, The Sims, and Battlefield. The gaming industry, despite its massive size and popularity, is facing some headwinds. One of the biggest challenges is simply the sheer level of competition. You've got new studios popping up all the time, and the battle for gamers' attention is fierce. There's been some backlash against microtransactions in gaming. Many gamers see them as predatory, and a way for companies to nickel and dime them. EA has been particularly criticized for its use of microtransactions, and that's definitely impacted their reputation among some gamers. Alright, coming in at number 3, it's Tesla, down 11.89% so far this year. Tesla, they need no introduction, right? They're the undisputed king of the electric vehicle market, and their CEO, Elon Musk, is a constant headline grabber. One of the biggest challenges right now is the increasing competition in the EV space. Every major automaker is jumping on the electric bandwagon, and they're coming out with some seriously impressive vehicles. This increased competition is putting pressure on Tesla to maintain its market share, and they've even had to cut prices on some of their models to stay competitive. Taking the number 2 spot, we've got ON Semiconductor, down a hefty 17.8% in 2025 so far. ON Semiconductor, they're a major player in the world of semiconductors, specifically those used in electric vehicles, power management, and industrial automation. The semiconductor industry, as we've seen over the past few years, is notoriously cyclical. Demand can fluctuate wildly, and right now it seems like we're in a bit of a downturn. A lot of companies overcompensated and stockpiled chips, and now they're working through that excess inventory, which is impacting demand for new chips. And the number 1 spot on our list of the Nasdaq 100's biggest losers goes to The Trade Desk, down a whopping 31.8% so far this year. The Trade Desk, they're all about digital advertising. They provide a platform that helps advertisers buy and manage their ad campaigns across various channels. The digital advertising market is going through some major changes right now. One of the biggest challenges is the increasing focus on privacy. Apple, with its app tracking transparency feature, really shook things up, and other companies are following suit. This makes it harder for advertisers to target users and measure the effectiveness of their campaigns. So, there you have it, the top 10 worst performing Nasdaq 100 stocks year to date. These companies have faced significant challenges leading to their current standings. But the question remains, will they bounce back? We've got everything from software and retail to pharmaceuticals and semiconductors. Each sector has its own unique hurdles and opportunities. For instance, software companies might be struggling with competition and innovation, while retail could be facing supply chain issues and changing consumer behaviors. It just goes to show that even in a bull market, not every stock is a winner. Market dynamics are complex, and various factors can influence a company's performance. Economic conditions, industry trends, and even geopolitical events can play a role. The market is constantly evolving, and what goes down can often come back up. Historical data shows that many companies have rebounded from tough times to reach new heights. It's all about resilience and strategic adjustments. Some of these companies might just need to make some adjustments, weather the current economic storm, and come out stronger on the other side. Leadership changes, new product launches, or strategic partnerships could be the key to their recovery. Do you own any of these stocks? If so, it's crucial to stay informed and keep an eye on their progress. Regularly reviewing your portfolio and staying updated with company news can help you make better investment decisions. Are you buying the dip, or are you staying far, far away? Different investors have different strategies. Some see downturns as buying opportunities, while others prefer to wait for more stability. Let me know in the comments down below. I'm curious to hear your thoughts and strategies. Engaging with the community can provide new insights and perspectives. Don't forget to drop a like on this video if you found it helpful, subscribe to the channel for more finance and investing content, and hit that notification bell so you never miss an upload. Your support helps us bring you more valuable content. Thanks for watching, and I'll catch you in the next one. Stay tuned for more insights and updates on the stock market.